Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
We are joined by Mr. Sanjaya Gupta, Managing Director of PNB Housing Finance, to talk to us more about their Q4 earnings. The stock has been in focus on the back of a couple of news points in the last couple of weeks, which were not so positive about the company. So, Mr. Gupta, while the street is appreciating the additional disclosures made by you with regards to the developer book, you told the analyst yesterday that about 900 crore rupees of the developer loans or the corporate loan book is stressed. So how much comfort do you have on these loans with regards to these assets continuing to perform in future and delivering? And also one more disclosure that you made is about the 30 days delinquency. That number is being taken well, a number of about 1.7%. So would you be able to maintain these numbers going forward as well?
Well, one is that, as we very rightly said, that the management of this company is a very conservative and a seasoned management team. And hence, these accounts, though they are running current, we actually use qualitative criteria to put them into stage 2 in the Ind AS regime and create an ECL provision over the life cycle of these accounts. And we are carrying quite handsome ECL provision, plus we are carrying steady state provision of about 156 crores on our balance sheet. So we are pretty sure that we will be able to resolve or cure these accounts over the time period, and a reasonable time period of, let's say, end of Q3 of this financial year. And out of that 900 crores, already one account is in a very advanced stage where I cannot name these accounts or who is doing what sort of a joint venture, is in a state of being taken over by a very large business house of the country. And so basically to a person like me, it's about 600 crores spread over 5 accounts, where we are working very closely with our developers and are working out a resolution, which will mean that the projects will once again be back on track when it comes to the pace of construction, the pace of sales, the pace of cash collection. Otherwise, they are compliant projects. It is not that they are non-compliant projects. So, it was required because there was a lot of news flows which were not so healthy about the corporate finance loan book, that we go ahead and make an annual disclosure on these accounts, and hence proactively, in the most transparent and compliant manner, we made those last evening. We have even discussed them with our board yesterday before going to the media and on our website. We have put a very strong leadership team headed by the 2 executive directors, one on the business, one on the risk side, and a dedicated team to start resolving these accounts and bringing them back on track. So it's a part of a job. Resolution is a part of a job. There's no credit which does not have credit risk in it.
Sir, out of this 900 crore rupees, how much have you provided at the end of FY19, and how much is the expected loss in the future?
Well, I do not expect credit loss in any of these accounts. And as we have said, we have also demonstrated over the last 12 months that we resolved about 115 crores, and the credit loss was only 2.15 crores on it. And these all these accounts have got, I would say, the security values are more than 2.5 times. We have got valuations done as recently as 31st March of 2019. They have, handsome amount of sold inventory from where a lot of receivables can come if they start constructing at the right pace. There is also a lot of opportunity on the unsold inventory, and I do not expect that we will have much sort of a haircut on any of these accounts. And the ECL provisions and the steady state contingency provisions of 156 crores are far too much in excess to even to bear all the, in case there is a credit loss, to bear a credit loss.
Sir, in Q4, how much were the fresh disbursements specifically to the developers, and has that gone up, or have you gone slow in this quarter?
Well, during the entire FY19, the corporate finance disbursements quarter on quarter have been only coming down. And if you compare quarter 3 with quarter 4 of financial year 19, our disbursements actually got compressed by about 2%. And why they got compressed was that actually our retail grew, but on the corporate finance we came down by 37%. Because today good credit is also sparse across the country, and we are very clear in our minds what sort of credit we are going to extend to anyone, whether it is retail or corporate.
So how is it panning out on the retail side? Because one of the analysts pointed out to me that Q4 usually sees a sharp correction in the retail NPAs in the fourth quarter, so which did not happen this time around. On the retail side as well, is there any sort of asset quality pressure, because developers are under stress on all fronts?
You are very accurate. Even on the retail side, where the NPAs have not got resolved are the ones where the projects across the country are moving slow and the customers are becoming reluctant to pay the developer or to the housing finance company. And that's the only reason why retail NPAs compared to quarter 3 and quarter 4 did not see a sort of a downward correction. And these are projects spread across the country. We have a very sort of a tenacious technical team which has put a stop on further disbursements or further acquisition in these projects across the country. I think there are about 267 such projects which are in our portfolio where the customers are, where the developers are not constructing, and hence the customers are reluctant to make future payments.
Sir, a word about your liquidity picture. In the 3 to 12 months bucket, your ALM is slightly negative. So would you be taking measures to enhance the position in these buckets?
Well, one is that we are carrying excess liquidity of about 7,000 crores on our balance sheet this year. Plus, we have about 2,500 crores of lines which are sanctioned, contracts already signed and executed. Whenever we want, we can draw them down. Plus, we have a $1 billion MTM program on the ECB, where it is already underwritten by about 30-35%. I can't give you details of the banks and multilaterals who have done that. Plus, our deposits are doing fantastically well. They have grown about 4 times if you were to compare month on month, both on volume and value. And we will keep a very high level of focus in developing that franchisee. And so I don't think liquidity is going to be a concern for this company at least.
But sir, your tier 1 is about 11%, and recently the credit rating agency CARE also highlighted the liquidity concerns, also concerns regarding the rising of the corporate book as a percentage of your total books. So with this amount of liquidity that you mentioned, would it be enough for you to carry forward your activities in FY20? And also just connecting the dots with regards to the rating agency's action, would you be taking it up with them with these kind of clarifications?
Yeah, so one is, you also said the asset liability gap. On that, let me tell you, don't get over concerned, because securitization has become a business as usual, and every quarter we do it. Even last year we did about 7,300 crores of securitization, and it was very much uniformly spread over quarter on quarter. This year also we will be securitizing some pool every quarter. So that will take care. When it comes to capital raise, let me assure everyone that the management, right from the IPO time in 2016, it was envisaged that the company will require additional tier 1 capital when the balance sheet portfolio size would be about 75,000 crores. It is exactly knocking there. Plus, we had indicated that we will reach this level in 2020. So even time-wise, we are there. Plus, the management, the board, and the shareholders are all aware of this requirement. And very soon, within a couple of weeks or 3 weeks, we will have a very, I would say, intense discussion at a board level to crystallize the tier 1 capital raise program during this year. And once that is approved by the board and the stakeholders committee, we are certainly going to, be on the, certainly on the course or the path to raise adequate capital for the company. The same team had a very successful stint at the IPO level, and the same team will do a second round this time. I'm very sure on that.
Okay. So, sir, as the times have been really tough for NBFCs and housing finance companies in particular, so and specifically PNB Housing Finance, there have been some allegations made, there have been some concerns also raised. So, under these circumstances, would management retention would be a challenge?
I don't think so. This management team has been there ever since 2010. When we sort of started our business process re-engineering. I think we are pretty glued to each other. We have a very highly motivated team, and we are objectively driven, and these are challenges in which we also see opportunities for ourselves to further prove our professional girth and the management depth that we have built over the years. So I don't think that management team retention or retaining the management team is going to be a challenge.
So
we have a purpose, and we are never shy. We are never shy of taking on challenges.
Sure. So recently there was a PIL filed against PNB Housing, making several allegations of illegal lending and not following the regulations. What do you have to say about that, sir?
Well, we have responded to it. Media has also covered it. You cannot, stop activists in putting allegations. I can assure you that PNB is a highly compliant company on all vectors of business operations. And personally, we have checked, once again on the system and on the site, on the stage of construction, and our disbursements are perfectly in sync with the stage of construction on site for those projects. So we are very sure. People might allege, when the times are not good, people like to throw more stones at a fruit-bearing tree. Do remember that.
Sir, just one last question in case I missed it. So you said that you have a $1 billion ECB program lined up, and also there were reports suggesting that you also plan to raise 10,000 crore rupees via NCD. So could you confirm that for us?
Yeah, the ECB program we have registered. NCD is a enabler. If the wholesale debt market or the corporate bond market is good, we have the empowerment to raise bonds. So that is basically an enabler. If the markets are conducive, then only we will go to the NCD market.
All right, sir. With that, I'll wrap up this interview. Thank you so much for joining us, and I hope you ride over these tough times with a lot of ease.
Thanks.
Thank you, sir.
Thanks a lot. Thanks a lot. It really means a lot to us. Thank you.